have a couple of co-panelists, Vlad Nastasi of Consilium in Romania.
Hello.
And I'll give them an opportunity to introduce themselves in a second. And Dimitris Skalios of Athens, who is going to tell us some more about the Greek market, hopefully from a little different perspective. Some things we hope to cover as a panel, some trends, one in the couple of local markets that these gentlemen represent, but I think more broadly, what's going on that affects the distressed investing universe across Europe, and I think that leads into the final panel of the day we have. Maybe at this point, I'll just say, why don't you guys take a minute and introduce yourselves and maybe what your businesses are about? Mike?
Good afternoon, everybody. My name is Dimitris Skalios. I'm happy to be here. Thank you very much for the introduction. I'm with Sigma Catalyst Partners in Athens. We are a boutique M&A advisory, a special situations M&A advisory based in Athens. We cover mainly Greek SMEs and corporates. We help also funds seek and execute opportunities in Greece, as well as help SMEs restructure and raise funds for real restructuring situations. Thank you.
I have mine.
Hello, everybody. My name is Vlad Nastase. I'm from Concilium Consulting, a company based in Bucharest, Romania. We do technical management services, corporate finance, and M&A, both on special situations and on the good side of the business, let's say. And happy to be with you this evening, and thank you for taking your time to join this panel, actually.
Thank you, Vlad. I'm Peter Briggs, and I'm with Alvarez Marsal. I run our financial institutions group. Globally, which sounds very large, that's mostly US and Europe and a little in the Middle East, and we're thinking deep thoughts about Asia and Latin America these days. I spent about half my career at Citibank, much of that in Central and Eastern Europe. Started the corporate finance and capital markets business in the 90s and Citicorp Venture Capital for Central and Eastern Europe, again back in the 90s. Then Solomon Smith Barney happened with the merger that was messy. Joined Alvarez & Marsal, which at the time was about the size of this panel. Today we're whatever we are, 3,500 people, 600 partners, and 54 offices in 24 countries, or some, I have to check the website, it goes up hourly. Been an amazing thing to be a part of and very much enjoyed. I spent a good chunk of my A&M time in corporate restructuring. Started our business in Germany, Central and Eastern Europe, Russia, ran the London business. And then when Lehman happened, managed the wind down of the loan and fixed income portfolios of Lehman, which begat forming our financial institutions group. Here we've been involved in advising on the creation of Sareb in Spain, advising the central bank of Cyprus at the time of the bail-in, not bailout, not a very popular transaction. Advising the systemic banks in Greece and the central bank in Greece on issues like capital controls, which has come up a couple times today. How do you get your money out of places is an important thing to know. So a lot of systemic work, and of course we advise individual institutions. Not so much of that to do right now because the market looks pretty benign. So just to talk about set the stage for what Europe looks like, John had actually emailed me a bunch of questions. Who won the Eurovision Song Competition in 2005? I'm not sure these are relevant questions. And Dimitris, you know the answer to that question?
I don't know.
Greece, you could have guessed.
Greece won.
Before the crisis. You guys were
Thank
good
you,
stuff
thank
before the crisis.
We won the Euro as well.
Also, yeah. It was a big year for Greece, 2005. Right. The current environment, you've got, we're 10 years into a recovery. Ed Altman tonight's going to tell us where we are in the economic cycle, I think. We're a lot closer to the end of one than the bottom of the last one, and the German economy is starting to slow, and part of that's because the Chinese economy is not doing so well and buying as much machinery out of Germany. We've got Gilets Jaunes walking around the streets in Paris. We've got an over-leveraged Greece still dangling at the bottom of Europe. We've got A very confusing Italy, politically and economically active, but uncertain as to outcome. And then there's Brexit. It's a shame John isn't here. He was going to explain Brexit to all of you, being the only Brit on the panel, and he was going to do that, I understand, through interpretive dance, as legitimate a methodology as any that I'm aware of. But I for one, am missing that. I wish he were here now to do that. I'm not going to even try as to what happened on there. I guess the point is, many of these forces are conspiring to create an environment where there's a lot more downside risk than upside opportunity in the general economy, and therefore the value of assets on everyone's books. You can look at that pessimistically, or if you're a restructuring person, optimistically that this could make Europe great again for distressed investors and restructuring advisors in the near future. So the question is, if you buy the thesis that there's lots of vulnerabilities across the continent, what are the triggers, and first question to you gentlemen, what are the triggers which might set a fire, and where would that risk first manifest itself, either by asset class or by geography? Okay. Go ahead, take a shot at it.
There are two views on that. One would be the European view, the other will be with the Greek view from my perspective. In Greece, I believe the negative stuff is mostly behind us. During the period where Europe was doing well, Greece was not doing well, so at some point they started dealing with the NPL with the NPL issue. We've seen over the past 16 months many NPL transactions, many banks already sold or outsourced for servicing, and we as restructuring and M&A professionals, we look forward to dealing with the refinancing of these companies, especially the SME companies, given that it's easier to deal with a servicer or the fund that bought the loan rather than the Greek banking system. And of course, in Europe, so what could go wrong? Some political instability, which is not expected, however. I mean, we have elections, but we pretty much know who's going to be elected. And I'm sure, given the Troika and the European Union guidelines that any Greek government would have to follow, I don't project any new policies. I mean, there will be different calibrations, but as different parties have different agendas. However, the overall policy, sort of, austerity, austerity in the sense that focusing on having a surplus, structural changes like privatization, all these things will have to continue regardless of who the new government is. So I don't really foresee, as I says, I don't want to bless Greece or anything, but I think all the worst is behind. And people who follow Greece, they know that there was a lot of worst that we went through.
So we can quote you on that in a couple of years from now. Okay.
Yes. I will risk that. Thank you.
On our side, at least for Romania, one of the biggest challenges that the economy is facing now is the lack of workforce, because quite a lot of people from Romania moved, and the demographics and the forecast of them are not looking very well in the future. So even if the macroeconomics numbers are positive, the government is saying that 5% GDP growth is expected. Some are reluctant, but still in the 3-point-something area, it will be most likely. Romanians are leaving the country, and the workforce is a challenge for most of the companies. And if you look on companies in special situations where the workforce is more sensible and sensitive in the same time, they are likely to move from that. In the same time, you've mentioned we are not that touched by I don't know what happens in Germany, for instance. Everybody is talking about the automotive industry in Germany that is doing some that there are some hiccups there. But in Romania, we do have some subcomponents that are manufactured there, but nothing related to the engine itself. So even if the diesel area is closing, we are not that affected in terms of economy and companies performing there. On the banking system, there was a lot of cleanup in the NPL section, so I think the area of portfolios is pretty much gone. We've decreased from 24% to roughly 6% now, so nothing major is about to happen. But new players are coming in the banking system and looking on smaller banks and trying to consolidate. And I think consolidation, at least for Romania, is the key word to look at from economics perspective, because there are a lot of opportunities to be taken and a lot of synergies to be created by having this consolidation process. And on the regional level, if this process will be a successful one, we can have some champions to become regional players. Not yet there, but with perspectives.
So on sort of a macro basis, I talked to some of the heads of special situations at like the universal banks. The most common thing I'm hearing these days is just looking at the structure of the debt markets that are out there. Two forces at play. And this may sound sort of indirect and kind of wonky corporate financy, but ultimately it comes down to a competition for capital at every asset class and geography. One, there's an enormous overhang of triple B minus paper, what used to be an investment grade world of issuers. Thought they were schmucks for maintaining their AA ratings. And investment bankers convinced them that with interest rates so low, they could afford to be even triple B minus, the lowest rating of investment grade, and pay a very small premium, still be investment grade and be able to access the investment grade investors. And so there's US dollar issuers, both US and Europe, about $2.7 billion of this stuff, with only 300 issuers, so very large issuers. And then you look just below that, and we have, and we've gone from something like, I forgot what the statistic was, 90% of investment grade companies being A or higher, and now it's 50. So basically the number of truly investment grade companies has been cut in half, and the rest of them are now, have borrowed an extra trillion or so, paid 800 billion in dividends and stock repurchases, so they haven't invested that into their businesses for the future, nor have they repaid debt. They've paid it out to shareholders and propped up their share prices. So we have a wonderful equity market out there, at least in terms of valuation. But we're at the end of a business cycle with a ton of that debt. What's that got to do with the non-investment grade universe? Well, and Ed can tell us later, even a mild recession could cause some material percentage of those guys, those issuers, to become upper quality non-investment grade players. That market's so much bigger than the non-investment grade business that they would crowd out capital. And of course, many holders of investment grade paper can only hold investment grade paper, so they're become forced sellers. So the yields go up on the non-investment grade paper. And if you could earn a good yield owning double B plus paper rather than single B minus paper, well, then that's what you're going to do. Where does that leave the single B minus, B flat, B plus, double B minus LBO market, of which there is approximately 1.2 trillion of that stuff? Huge refinancing risk. And we don't need a rise in interest rates to have a spike in interest costs to that universe of issuers if you have this competition for capital where better rated companies have crowded into your market. So this is all very, as I said, sorry, technical wonky stuff. It's got a punchline to it here in a minute. That crowding of non-investment grade, of fallen angels, that's a term from the 80s for you 80s bankers, of investment grade companies falling down to non-investment grade, we haven't seen that phenomenon in a long time, but it's likely to repeat itself and happen. That's one of the things that'll make this downturn different. And we don't need a very steep recession for that to have an impact. Meantime, down in non-investment grade land, banks no longer, the big underwriting banks, don't hold this stuff on their books. They hold 10%. They get agency fees for placing bonds and leverage loans. The rest of it gets sold. They used to sell it. Banks used to sell paper and syndicate it between themselves. They don't do that now. They sell it to CLOs. And so we now have a staggering amount, approaching $1 billion cumulatively, US and Europe, of CLO paper, mostly the lower rated LBO stuff, incredibly. And we're doing that at a time when the average EBITDA multiple is 10 to 12 times. The average senior debt to EBITDA is 6 times. You take that paper, you put it in a CLO, you leverage that 80 to 90%, and it looks a lot like what we did with mortgages going into the last recession. The regulators squeezed the risk out of the banks, pushed it all into the CLOs. The difference between a CLO and a bank, there are many. One has a deposit base. The other one largely borrows on 364-day credit lines because it's AAA rated paper. So the very same banks that have tried to syndicate down their risk of the leverage loans now own it all in these allegedly AAA vehicles, again, much like the last credit cycle. What's that got to do with the price of bread? It means that we don't need a very big economic recession to have a sharp dislocation in the leveraged business, which could then allow for some much higher yields. And if so, and if you could earn good yields in liquid, rated and listed paper, why would one spend a lot of energy trying to buy NPLs in Greece or Romania or a lot of other asset classes in emerging markets that are very challenging? It's a good question. So we'd have a big allocation of capital. That is a thesis that I have heard, and a fair amount of capital is trying to figure out how to position itself for that type of an environment. Now, again, the question that they all ask is, so what's the trigger and which asset classes and where is this going to manifest itself? The question I just asked. I'm not sure anybody's got an answer to it, but that is the most, since we don't have a special sits panelist here with us, and that was the name of our panel, I just thought I'd offer you the most, and they tend to be they sound like investment bankers. It sounds like that. That's the thesis that I have put forward by global heads of special sits at a few of these banks. I think that comes back to the market that many of us play in the NPL market, because one has to be very careful. Several people earlier, Morton and Clarence and Denise Hamer earlier, all commented on when you're putting money into, let's call them smaller markets, Romania, Greece, elsewhere, you can buy it as best you can and structure it as best you can and find the best manager or servicer that you can, but at the end of the day, you want to get your money back. And so question to you guys in your markets, and I think for everybody, where's the exit? How do you get your money back out? Because you don't make money buying stuff, you make money selling stuff. And so the concern in these less liquid markets, especially if the thesis I just put forward holds any water, is how in your markets as they exist today, of the people that have bought distressed assets or done restructuring deals, where are the exits, and are those going to be robust enough for a tighter liquidity market that I've just described?
I think one key thing is about the timing, how much they are willing to stay until they will do that exit. Because if they want, at least for Romania, if they want something quick, maybe it's not the best way to look at it. Medium to long term can be a successful exit, because in this time you can do a proper restructuring. Now, for instance, the banks are more knowledgeable than they were some years ago. They have the time to actually be involved in a restructuring process. They don't have that time pressure to get rid of the loan from their balance sheet as part of a portfolio or whatever. So a restructuring involving also the financial part can be done in time. The size is the matter for is the problem for Romania. The companies are not that sizable. It's an SME-based actually economy to be considered by a big player, except if they have a regional interest and they want to put a step in through an acquisition, and then the size itself is maybe not that important, but the shape of the company is a crucial one. In terms of exits, a lot of big investment funds were looking to Romania. Maybe we don't have that much to offer now in terms of investment opportunities with a risk appetite, with a high risk appetite, but funds that are looking on the region and they're looking on their business to grow on that region, Romania, I think it's an interesting market and can offer that exit you are referring to. And one maybe recent example is the fact that, for instance, JC Flowers, the investment fund that was looking actually to Romania for some years, actually managed to step into the market, and they've acquired Piraeus Bank, the bank that was sold by Piraeus Greece, and they are now on active mood of acquiring other smaller banks and creating something more sizable than Piraeus is today. So I think if you look on their investment strategy, they can be seen as an example.
Peter, just to your point before, if this happens, and I believe you're right, in Greece we are used to for people demanding higher returns, higher yields for people to invest in Greece. So right now that's the game. I mean, where in Western Europe people would expect 5-6% in a similar asset class, in Greece they would expect 8, 9, 8 to 10. So if 5 to 6 in Europe becomes 7, and the Greek would become 12. The impact in NPL portfolios would be the values of the portfolios will be reduced. This will impact the banks, the systemic banks. So the investors could go in and demand higher IRRs. This will impact the balance sheets of the banks. I mean, they expect certain recovery rates that they would not get. That's just on that point. Regarding the exits now, to your question, I believe there'll be regional M&A trade sales. I agree with Vlad, the sizes are small in Greece as well as in Romania. There are corporates and SMEs, but mainly an SME environment. However, in certain sectors like tourism, like hospitality, like logistics, transportation, we've seen activity, we've seen investors, international investors. Tourism is a sector in Greece that is driven by international demand. It has nothing to do with the local buying power, purchasing power of the people. And we will see, in terms of, we'll see trade sales regionally initially, and also with middle market European players. So of course, a company that an investor goes and restructures, and they start with 10 million in revenue, and they restructure the debt, they clean up the balance sheet, and also they help improve the EBITDA, expand in a couple of new markets. And you know, a 10 million company becomes a 20 million company, which is not easy when you start with 10 million revenue. The 20, 30 million company could be a target for a regional, for a Western European player, a middle market Western European, and we've seen that happening. We've seen that a lot in tourism and hospitality, but also we've seen it in other sectors. We see it in the food sector, export food sector in Greece, where there are entrepreneurs, individuals, international investors picking up SMEs in trouble, like ice cream chain, confectionery company, you know, 10, 15 million revenue companies. So my reply would be trade sales.
We heard earlier that, you know, Spain and Ireland were ahead of other markets in addressing their issues and putting one form or another of aggressive NPL management and government-sponsored NPL management. And then, of course, we've had economic turnarounds. And, you know, was one causal of the other, or is it just they're correlated? Certainly, it's the case that, you know, you feel a lot better about buying an asset. You do the best you can to buy them, but then if the economy grows, you know, the rising tide lifts all boats. So again, as people look at your economies that you're both focused on, we can do everything we can and advise, the potential investor into Greece that this is the right asset to buy and this is the right structure and that's the right servicer. But what you really want to know is Greece going to grow at 2 to 3% or higher for some sustained period of time? Because then you don't have to be that smart. And if your strategy is about being smart, that's never worked for me. You want to invest, you want to put yourself in the way of success. Invest in front of places that you're going to get a wind behind you. So do you think, and one of the real measures of that is in Greece in particular, Greeks took a lot of their money, almost half the deposits of the country, out of the country and still haven't put it back. It's very difficult to convince other folks to put their money into Greece when Greeks won't put their money into Greece. That's an indicator of, it's the only country in the Eurozone.
As deposits, you mean?
Hmm?
It's different to put as deposits or invest in assets.
I don't think the Greek government or anybody else or even the banks would be disappointed if instead they put it in and invested it in businesses. But ultimately it has to pass through a bank account, not a piece of New York real estate, which is where much of it's, sitting now. So do you believe that Greece, tough question, but is it a fair, for all the investors and advisors who look at Greece as an opportunity because of the 90 whatever it is billion of NPL sitting there, is it reasonable to have confidence that whatever price you buy your paper at, that the tide's going to rise in Greece?
Okay, not whatever price, of course. And that's why it's interesting. It's because the investors still have power to demand lower valuations, especially in SME, less liquid transactions. If you go to the large NPL transactions, maybe I would be more careful. And as somebody in a previous panel said, you'll have Apollos and Bains that trying to buy everything, and of course this drives valuations up. But there is this segment of corporate and SME business transactions, and I will explain what I mean by business transactions, that there is limited liquidity, there is no competition, it's private deals. You do a deal with a business person, with the owners and with the banks. So all you need to say is I'm putting so much money in, provided the bank does this haircut and this restructuring. And if the bank says no, because they want less haircut, then you can walk away, and you should walk away. I would differentiate businesses, export businesses, because Greece is a country with, 9, 10 million people and 25 million tourists. The tourists that come every year, they buy sodas, they eat sandwiches, they consume. And they consumed a lot, and the tourism season now has become more than the summer. So Greece is bigger than that. I mean, it's not just tourism, it's a lot of other industries that are affected by tourism positively. One thing I will be careful is real estate, because for many years in Greece, banks were lending on the back of assets and not on the back of cash flows, EBITDA, etc. And there is a lot of real estate stock. I don't know if there's liquidity behind that stock. There are specialty real estate assets that have values, and these are the ones that command demand from international investors. This could be, of course, hospitality-related assets, and also residences, villas that are in areas that are attractive for international buyer, even a private person. And there are very nice suburbs in Athens with very, very expensive villas in the middle of green that nobody will buy. And the banks, what they do is they do an auction, they liquidate this, they enforce the collateral, and then they are the only buyer is the bank. And they just, as everybody knows, they just transform credit risk to real estate risk. And the thesis is that real estate is going up. It will go up, so this will become a benefit for our balance sheet and for our equity. Okay, this is the case, but not in all types of real estate. And I don't believe anything that's not close to the sea has some tourist angle, or close to ancient places like downtown Athens. You see rundown apartments with very good vacant utilization, rental utilization, because because of Airbnb. And there's a lot of small construction activity of people buying low, refurbishing small apartments in downtown. So I would be very careful with real estate, because not all real estate is real collateral. And a big part of real estate in Greece, I believe, has been overvalued.
Interesting. Vlad, in Romania is a different story than Greece. But and it's always been on the fringe. It's been in this no man's land between, and as an investor in the past, it broke my heart putting dollars in the 90s into the privatization. I appreciate that's now a very long time ago, into the privatizations with great optimism in the 90s that we bought great companies at good prices and then watched the currency devalue, and we ended up selling these companies back to local entrepreneurs at even lower prices because that was the only way to get out of them. So maybe I'm jaundiced by my experience, but it's one I'm sure is shared by many who've invested in these types of markets. So I wanted to give you your chance. How is it different today? Because once burned, twice shy. And secondly, and as was just alluded to by Dimitris, where are the opportunities? Each market's different as to where the attractive assets are, either industry segment or asset class. If folks are going to succeed in markets like the smaller markets of Central and Eastern Europe, it's usually because they've got real focus on knowing how they're going to add value to a particular asset or how they're going to get network benefits out of having a bunch of these things. So where's the opportunity in Romania today? And how is it not like my 90s experience?
So the opportunity for sure is not hospitality, because that is taken by Greece already. Although in the 70s, Romania was preferred by, I don't know, Czech guys, Polish guys, Swedish guys for the seaside. But now everybody...
They're all on the French coast.
Exactly.
Now
Now they've moved to better locations. So hospitality is not our thing. But for instance, food, agriculture, it is. We were traditionally one of the biggest producers of food in Europe since between the two world wars. So we have a long-lasting tradition on that. The quality of land is still good. The prices increased, but still affordable. We have a good geographical location in terms of connectivity by sea with other areas, Middle East being one of the traditional markets that are still attractive for a big player, a big international player to look at. So I think this area or areas that are close to natural resources, because our country is still very rich in terms of natural resources. Recently, huge gas was found in the Black Sea, so a lot of interest from that is coming now. Is an area to look at. IT-related things, because Romania has a very good IT infrastructure, still qualified people at affordable prices, and a lot of companies are trying to relocate to Romania on their regional hubs. So these kind of things are to be looked at. Logistics. I think in terms of logistics, we have huge room of improvement, and the need is there. We have good connectivity. If Constanța Harbor, for instance, will be further developed, which is a huge thing, it will be a shortcut way from the Middle East merchandise to enter into Europe rather than going to Holland. And that is a debate, and maybe that's why there is a political thing also on Schengen accession of Romania, and Holland is opposing to that. So what changed since your bad experience? Romania has matured. I think we've all learned from that. In terms of economy, is more stable. The exchange rate is of course changing, but in a controlled way. Let's call it like that. We've had the last 2-3 years economic growth quite sustainable. We are, let's say, in a position where everybody is looking to Romania as being a country with potential. Not yet reached that potential, so there is still hope to reach it. Privatizations are over, so or at least the big ones. So no funny deals. We have mature companies that are still on the market. We have actually some quite small heavy industry still living in the country, which is unfortunately because we've had some tradition on that. But I think now the opportunities are there, but on different landscape than they were on the 90s. And also the economic and political landscape is a totally different one than back then. And you have, I think, an educated counterpart now if you want to invest in Romania or to look at Romania.
So what about automotive sector? Because I always felt that the positive about Romania is automotive suppliers, automotive components, that something we're not having in Greece at all.
Yeah, we have Ford, for instance. Yeah, Ford is producing one of their successful models is produced in Romania, in Craiova. Renault is producing at Pitești, and one of the models there is very successful in the group. These are the only two. Suppliers, there are, and what I've mentioned before, it's a good thing because now you saw that the tendency in Europe is to move from diesel engines to electric ones or hybrid ones. We are not involved very much in the subcomponents related to engines, rather than, I don't know, wheels, cables, these kind of things. So we are not very affected by this kind of switching of the industry trend. And still, Romania has qualified workforce. What's lacking there is the infrastructure. Because, for instance, when Mercedes wanted to do a huge investment in Romania, they've preferred Hungary because of the infrastructure that is better than in Romania. But they've placed the factory close to Romanian borders because the workforce is coming actually from Romania. So if the infrastructure will significantly be improved, then I think also this sector will grow. Because right now, I think infrastructure and investments in general is a big challenge. You've mentioned earlier, the current government has provided this kind of growth, but the level of investment allocated from the state budget is at its minimum. So it's a consumption-based budget now, which I think is quite dangerous on a medium-term basis.
In the interest of time, I know we need to be wrapping up, but I wanted to open the floor here to some questions for our panel. Folks out there, I know we're at that point in the afternoon where you're either reading your news, or scrolling through your phones or stabbing yourself in your leg with your pen to try and make it to the last session. I'm sitting on my pen now. Anyway, questions?
Going back to your analysis of the flow of the crowding out of the, I follow your reasoning up to the very last point, but then I lost you at the very last because I don't agree that the way out of the investment in an NPL portfolio is linked to the macroeconomic conditions necessarily. In fact, it could be it can be a hedge to the general economy. You're looking at getting money back from debtors that you bought at 19, 20, 21% of their book value, and you're looking at diversified portfolios. So if you say, how are you going to get your money back? You're going to get your money back for sure at one point. It may take longer, it may take less. But I think that's where that market is different from the spread-driven market, where you have an issue of a direct link between the. Certainly, it's an issue if you're going into that investment. You'll probably want more yield going in, but once you're in, I think the effect is, the money you're going to get your money back. Period. It's not a question of if; it's a question of how much and and how long it will take. It may take a bit longer, but
I didn't hear a question, but just to respond, it
wasn't a question; it was an observation.
Yeah, no. I think there's a distinction in asset classes. Just to add to your point, there's a distinction in asset classes here between buying the SMEs and consumer loans and these types of asset books that you're buying at steep discounts. And the comment I was really talking about there, and maybe we're muddling a lot of both geography and asset classes together here. is the corporate loan marketplace. This knocking on effect is going to crowd the least healthy and the more levered corporate credits are going to end up at the short end of the stick. And what that can lead to is they don't have to be terribly impacted. EBITDA doesn't have to drop by 80%, as happens in an auto player has happened last time around. It can drop a fairly modest amount when you're leveraged 6 times. And now the banks, if they can't sell to the CLOs, they'll have to put it on their own books. They haven't done that in a while. And when they do, given the capital requirements, capital reserve requirements now, they're going to require real pricing and collateral and even, new word, covenants. Haven't seen any of those in a while. Will all come back because it's going to have to be parked on their books. So this is all the things that are going to make that single B, double B market much tougher. But that's this crescendo there I was talking about, this cascade, is the corporate credit market, which is very different from the portfolio asset play that we've also been discussing here. So, and maybe I mixed my
So NPLs
my
in Greece are okay.
Professor Altman. Watch your water glass there.
Paulo, your question, there's another element to it, if I can add something to what Peter said. And that is timing issues of selling NPL portfolios that you've bought in a prior period. If you have the downturn that Peter is talking about potentially coming, and I'll talk about that tonight when I think it will be coming, but let's say in a year from now, in major countries like the US and China, and I'm not so sure about Europe, but let's suppose you do have a big increase in new NPLs and new bankruptcies and new defaults. The people who have bought NPLs now, who have an objective to sell in 1 or 2 or 3 years' time, perhaps, they will face a market with a huge increase in new NPLs and new bankruptcies, and it's very easy to show the negative correlation between default rates and recovery rates. So when you have a big increase in defaults, you're going to have a big decrease in recovery rates, which is going to affect new defaults, but also existing NPLs to be able to sell them into the market. So I think it's a really interesting question of timing. Maybe 3 years after the big increase in defaults will be a fantastic period for buying NPLs, because then the prices will be much lower. And it will be a new generation. But it's a very interesting, subtle issue of what's going to happen to existing portfolios if there is another downturn. I think it's a really great question that you're both posing for the future.
Last question in the back there. Thanks, because I know we're getting the hook. Yep. Oh, I just want to put in a plug. If you want to hear more from Ed, my corporate finance professor of 37 years ago at NYU, who got me interested in the restructuring business, he will entertain us this evening. Please.
Yeah, hi, it's Roman Binter, APS. So yeah, I think regarding the downturn, obviously the question of timing is the key. Of course, I guess nobody can time. Question is, how do you position yourself? And I think you've mentioned that. I guess, or maybe perhaps question 2 is, would that perhaps to some extent be a function of cost of capital? I mean, obviously, when you're thinking of banks, I think they perhaps do have the luxury of, maybe take the money off the table and kind of build up a war chest for after the crisis, and then sort of come in, when all the pricing is depressed and sort of acquire assets after that. But when you're thinking of investment funds, I mean, they would have great difficulties to sort of pause at this moment. I mean, obviously they're driven by the need to place very quickly and large sizes. So they don't really have the luxury, and of course their cost of capital is much higher as well. So I guess the question is, does the cost of capital play a significant role, or do you think that at the end of the day, it doesn't really matter what your cost of capital is, everybody will react sort of ex post rather than ex ante, because the timing is just impossible to do?
Well, if I understood the question, it reminds me of Chuck Prince, who was the CEO at the time of Citigroup, just before the collapse and just before he was relieved of his duties as the CEO of Citibank, that, as long as the music is playing, we're going to keep dancing, and Citi was still dancing.
Yes.
And so because of the pressure to just keep doing it, even though you're, like the coyote having run off the end of the cliff and the feet are still moving, but it's down there. That's kind of where Chuck Prince was in Citi at the time, along with every other major bank. And it has a little bit of that feeling with respect to this leveraged loan marketplace that with such high multiples, et cetera. So it takes enormous discipline to sit down and to actively do nothing. It's just what sometimes is the very best thing one can do. The one analogy I can make is when Lehman collapsed and we were sitting on all the assets in Lehman, we had every distressed investor and private equity investor on earth calling us constantly, just saying, you have to sell us these assets at these cheap prices. And our answer was no. We're the only bank on earth that doesn't have to sell. We're already dead. And if we sell now, we're only just going to put more into a weak market and really cause the world to collapse. The best thing we can do for the world is just sit here and do nothing. Because either the world's going to rebound, in which case we'll sell into a better market, or it really is the end of the world and then it kind of doesn't matter. So we made a basic decision to actively sit in our hands while everyone, including our creditors, are screaming at us to sell, and all the buyers are screaming at us to sell, and we just said, don't answer the phone. We did that for quite a long time. Recovered a lot more money for the estate by just not trying to be too smart about it and just sitting there. And right now, one of those times where sometimes just being calm is the hardest thing to do. That's perspective, my view on that. Anyway.
I guess the big question, though, is can investment funds really afford that? I mean, they have tremendous. It's not just about pressure. It's about actually, fiduciary duties, etc. I mean, the structure they must adhere to basically forces them to keep on dancing.
Yeah, that's a conflict. It's a challenge. I know we're out of time and then some. So thank you very much, and please thank our panel. Thank you.